Hey there, welcome to the channel. So today we're going to talk about the yield curve. There's a lot of people looking at this right now to try to see if it's indicating a recession and when that's exactly going to happen, et cetera. But I think there's some misconceptions about it. Okay, so I'm going to go to this tool over here on the stock charts. I pay for the service and I like it, not super fancy charts, but what they have is this dynamic yield curve. So on the right, you can see the S&P 500. And as you move the line across the chart, you see on the left the yield curve. And the yield curve will have at the short end 3-month, then 2-year treasury, then 5-year, 7, et cetera, all the way up to 30. And one of the things that you notice here is as you get to a local peak in the market, you'll see that the yield curve flattens and then sometimes inverts. So right now, going up this peak back in 2000, you see how the yield curve very flat, then inverted, meaning that the yield, the interest rate you're earning on 30-year and 20 is actually lower than like the 2-year. And very close. It's very flat and very inverted. And then as the market breaks down, that's a totally inverted curve. And then as it breaks down, then the Fed lowers rates and brings it down. Okay, so let's look at this again. So what's happening on each one of these cycles, you see that at the bottom here, you have a normal, what you consider a more normal yield curve, a steep yield curve, meaning that, look, if I loan you money for 3 months, I have much less risk than loaning you money at longer time periods for 10 years, for 20 years, for 30 years. I mean, it's just very simple. You can look at it with a friend or a person. Like if I loan a person like, hey, I'm going to loan you $100 because you need $100. If I loan it for a week, it's much lower risk than trying to get that money from you 2 years from now or 10 years from now. Basically, the risk of getting the money back. So therefore, if in a normal economic situation, you would want to earn a higher level of interest the longer you're lending the money out. That compensates you for the risk of not getting paid back, right? So this is what you would consider a normal yield curve. Now, as the stock market goes up, blah, 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 and we see that the yield curve, once again, every time it gets to a peak, it flattens out and then even inverts in many cases. Then we go back as the market sells off. And then coming up, we have where we're at, getting to where we're at now. So back here during the Cerveza thing, we did kind of almost invert again. We got really flat. We didn't invert, but we did, flatten out. There's look at that, a little bit of an inversion on some of the durations there. And then as we go up, where are we at now? So right now we're still kind of got a decent yield curve, but some of it is flattening out. We're still really low on the 3-year. So what's happening now is we know the Fed is coming in and they're going to raise rates. And it's very interesting because there's a lot of people like looking and they're watching very closely the 2-year and the 10-year or the different maturities and trying to figure out like, hey, is the yield curve going to invert? Because historically, you can look at your charts and you can see this one-on-one relationship where like every time the yield curve inverts, even just for like a moment, you always end up having a recession. And in addition, we could look at charts here and we can see that every time the yield curve inverts, the market basically has a sell-off. And that kind of also can go. Now, the market and the economy are not the same thing, but there is a relationship there. So now what I'm going to do is I'm going to go to this chart here and we're going to look at this black line on the top chart is the Fed funds rate. Now I'm going back all the way into the 80s. So if you look at this, these are very high rates. The rates are on the left. So that means that's true. 18.5%. So very high rates back there in the 80s as Volcker was trying to kill inflation. But what you see is, basically rates coming off just the entire rest of the time. So now, okay, so let's go look at rate hike cycles. So let's go into the 90s. Here, the rates were going up. Okay, so this is the Fed funds rate. So this black line here is the Fed funds rate. Now, this is the rate that the Fed controls. And if you look at it, they have like pretty good control on this. Now, this is the shortest term. This is like the effective fund rate. This is like the overnight rate, very short term. And I've shown on other charts how this tends to track, like the 3-month treasury tends to track this pretty well. So the point is the Fed can't control the long rates. They can't control the 10-year. They can't control the 30-year. So if you go back and we look at this, what's really going on here? You can see back here as the market's up, what's going on here back in 04, 05, 06? For whatever reason, the curve's flattening out. But what's really happening is the short-term rates, look at here, short-term rates are over here like 1% or something, and they're moving all the way up to here. Next thing you know, over here, short-term rates are over 4.6%. So what happened in that time in 04, 05, 06? So if we go back to 04, 05, and 06 on the chart, well, what's going on? Well, I can tell you exactly what's going on. What's happening is the Fed is raising rates. Here we go, for 06. What's going on? The Fed is raising rates. This is the Fed funds rate. They are cranking up that rate. So my point is that people are looking and they're looking to see if the yield curve is inverting, and that means we're going to have a recession. But look, to me, it's misguided because we know that that's not really the cause. The fact that the yield curve inverted isn't the cause. The cause is this: the Fed increases rates. And what you see time and time again, they increase rates, they go too far, the yield curve inverts. Now here I am showing the 3-month treasury divided by the 20. So basically, if that short-term yield becomes greater than the long-term, you're going to be greater than 1, right? So we can see these moments of time. What happened? Going back to even here, this period of time, the Fed once again goes on a rate hike cycle here in 2000. Boom, boom, boom. At some point, they end up inverting the yield curve, and then the market comes down and then we end up getting a recession. Here, they go on a rate raising cycle. They end up inverting the yield curve, yada, yada, yada. Eventually, with a delay, ends up to a market correction. And then even over here in the cerveza sickness, once again, they come up, they invert the yield curve, and it causes very little here, except we get this situation with the cerveza sickness. Now, what happened here is interesting because the lag between these periods of time is kind of interesting. They started to come off on their interest rates already. So they did invert it very quickly, but then because of the cerveza sickness, they kind of came off. And in the end, due to the cerveza and stuff, we got a recession. Okay, it's small recession because they poured money in, but we did. So summarizing again, if we're looking at this and we're trying to figure out like, oh, is the yield curve going to invert? And you can look at it and say, well, that gives us a very high indication that we're going to have a recession. You don't need to look. All you need to look at is the Fed. Those yield curve inversions are driven by the Fed. The Fed, this is not market forces. This is the Fed driving rates up. They crank rates up, they go too far, something breaks, and eventually the market and the economy goes into recession. And then they immediately cut rates back down as far as they can, uninvert the yield curve. In other words, the yield curve is not the cause of the recession. The yield curve inversion is not the cause of the recession. It's not the cause of the market correction / crash. It is a response to the Fed raising rates. The Fed raising rates is the cause of the recession. The Fed raising rates is the cause of the stock market going down. It's very simple. We know how the economy is right now. You've had interest rates very low for a very long time. Back in here from 2009 all the way up to 2016, period of 7 years, interest rates were 0. Slowly, they move it up, and then they finally go into this big rate cycle here. Imagine an economy. How many businesses are formed? How many businesses did not go out of business during this time? Because the interest rates are so small and the cost of capital is so small. If you can get money for 0%, it enables all kinds of schemes, especially like for banking, investment banking, these guys and their swaps and all the stuff that they can do with that kind of an interest rate. The real thing that it does, it allows them to carry. In other words, they can borrow money for almost free, pay nothing for short-term money, and then they can buy stuff or sell stuff at longer term. And it's called a carry trade. So basically, if I borrow money at 1% and I loan it out for 3 months and I get 2%, then I'm making 1%, I'm making a killing. I do that all I want, right? And sure, the real numbers are I'm borrowing at 0% and I'm making 0.2% for 3 months or whatever the number is, right? You do that all day long and that works fine until something goes wrong and you can't get that money for 0%. Suddenly, if you were making 2% or 0.5% or 1% on the thing you were supporting, if the cost of your money goes up, if the cost of your money goes from 0 to 1% to 2%, then you can't make money on that and you have to exit that trade. And the problem is when you put interest rates at 0 for 7 years, you just get more and more people piling into all these trades where they get money for free. They can borrow money for essentially free, very low cost, and they can put them into speculative assets. And eventually, when you go to raise those rates, something will break. It happens almost every time. So that's it for this one. I just wanted to kind of try to put that in perspective for people. It is, once again, it's the Fed raising rates that causes it. The inverting of the yield curve is a side effect, but it's not the cause. All right, that's it for this one.